right now. All right, so we're going to go ahead and get started, I think, just to give us enough time to be able to get through everything. So we had a few more people hop on. Welcome, everyone. This is the second time we've done a Zoom meeting, which has been cool. It really is powerful to see how we can all remain connected even through this difficult time. But I'm really excited to invite Mark to this meeting. He's the author of this book, Creating Wealth Through Self-Storage. It's a phenomenal book. If you haven't bought it yet, definitely recommend it. It's the best book I've read on self-storage by far. And so I just go ahead and take it away, Mark, I guess.
No, thank you. Thank you. My name's Mark Helm, Louisville, Kentucky. Is everybody here mostly in the Louisville, Southern Indiana kind of area of the world?
I would say probably.
No, I'm seeing a no. Okay. Well, I've woke every morning, most of my life. I get out of bed and I hit the ground thinking like a realtor does. So I lost all visible means of support, financial support, May 1, 1985, when I got my real estate license. And I was a salesman for a paint company at the time. And I got my real estate license to earn some, quote, extra money. And my broker at the time told me that he would put, back then we had the Homes magazine. Y'all remember the Homes magazine? Well, they were free magazines. And my broker told me he'd put my picture on the page if I got 5 listings. And I thought, wow, what a deal. So I went out and got 5 listings real quick. My picture was put on the Homes magazine. And I had 1 property under contract, never had a closing. Yeah, hadn't made my first cent in real estate. And my employer called me into his office, threw that magazine down and said, I think you've got to decide whether you're in the paint business or the real estate business. And I just, in that moment, decided I was in the real estate business. So that's how I got in real estate in 1985. And by the 1990s, I was moving to commercial real estate, working with a developer and learning how developers think and marketing their product. And I saw early on that the people that I respected in the commercial real estate arena had a CCIM designation. So I went out and got a CCIM designation. And I ended up it cost back then about $10,000 a letter. And it took a number of years to get it. And I finally got my designation in early 1995. And very soon after I got that designation, I was sitting in my real estate office and I got a phone call one morning, and it was from the acquisition director of a REIT in the self-storage business. Now in 1995, I owned a couple of rental houses, but not much. I showed up to work every day in a tie. I had a property management company that managed office space in downtown Louisville, kind of B-class office, landmark building, cosmopolitan building. And I had a brokerage business at a RE/MAX broker, which gives you a lot of space and a lot of freedom. So I fancied myself fairly sophisticated kind of broker thing, and ran Argus programs on office. And when this guy called me up from self-storage, I related to self-storage like a pretty infantile kind of industry at the time. But when somebody calls up a broker and asks, can you help me find space? How many brokers do we have on the line in the meeting here? If you ask a broker, can they help you find space? There's usually only one answer, and that answer was yes. So I set an appointment to meet this guy, and he gave me some of his parameters, what he was looking for, and I found a few. And I went out and started showing him self-storage. And it did not take me very long to see what self-storage really was. At the time in 1995, non-climate control, kind of drive-up buildings you see, we're generating between $9.50, $10 a square foot. Climate control was getting on average around $12.50 a square foot. And basically all it is a warehouse, steel building, concrete floor. In our marketplace at the time, warehouse space was going for about $3.50 a square foot. Office space, B-class office, was going for 10 to 14 a square foot. So when I started seeing storage generating that kind of income, it caught my attention. But what really got my attention was, what I saw was that there were no commissions to pay. There was no tenant improvement costs. You were talking about doing the build out for the retail space you're leasing. No tenant improvement costs. What few capital expenses there were, you know what they are. You know you're going to repave every resurface every 10 years, blacktop maybe every 5 years. You know the life of a HVAC unit and the climate control. The few capital expenses there are, you can set aside a very small, we use 12 cents a square foot reserve fund, and you'll always have money there for capital expenses. You never have to hit your operating cash for capital expenses. So in the office business, we were pretty good. We had about an 80% renewal rate. That's how you judge your effectiveness in the management business, or at least how we did. So we had about an 80% renewal rate. It cost us on average about $5 a square foot to renew an office tenant. That included my fees, and usually we budgeted money for paint and carpet if we needed it to keep the tenant there. And we could spend anywhere from $10 to $20 a square foot to replace a tenant, which you're probably spending that in your retail deal that you were talking about doing. So when I saw in the storage business that if the tenant doesn't suite the unit, that operator was fining them, making them pay for it. If the tenant didn't pay, and I realized they weren't tenants, if the person in the unit didn't pay, they could auction that guy's stuff and get some of their cash back. In other words, they, in essence, had about a 20 cent on the dollar insurance policy on their cash flow. And their rates I was seeing these guys raising the rates 4, 5, 6% a year on average. And what I saw was, over a couple of years of working with these guys, they could predict very, very accurately what their cash flows were. And I thought, for a guy like me who doesn't have a lot of money to invest, and I mean, this was the perfect thing. Now, it was a different world in the 90s because local banks, I remember a guy at Republic Bank looked at me, Traeger said, "We'll never loan on storage. It is a specialty product, and we'll never loan on a specialty product." Now they can't get enough of it. SBA now even loans on self-storage. So it was a little bit different world back then, but I thought, how can a guy like me, I was living deal to deal in essence, get in this business? Now, what I saw was the one thing that I brought to the table was the ability to find the deals and analyze the deals. So that's what I brought to the table. I started looking for the deals, finding them, analyzing them. Then I would go out, present the opportunities one at a time, raise the money from investors. Then I would get some of the ownership for putting the deal together. And then I also had a company that managed the deals. So by 1999, I was starting to put a portfolio of properties together, and ended up putting about 4 properties together real quick. And the way I organized myself, it was kind of a majority vote, and we started getting unsolicited offers. And real quickly, I was out of the business about as fast as I got in the business. Because we got an unsolicited offer from a REIT, and investors voted to accept the offer, so we took it. And It was a few years later, I reorganized myself differently, got back in the business, and ended up writing the book in 2015. And since then have been putting a portfolio together of properties. We still use investor money to build our portfolio because I can put more properties in a portfolio using other people's money. And I'll tell you how we structure it if you all are interested in that. But our goal has been to use other people's money to build a portfolio that we can control and own, give our investors an above market return, but at some point in the deal, we take over the majority of the cash flow and the upside of it. So that's kind of been what our structure has been. And I love self-storage. I got back into business in 2008. How many, you all, well, most of you are pretty young. You weren't doing business in 2008, were you? Do you remember 2008? It was, yeah, interesting time. So here's what happened in the storage business, 2008. On average, we lost about 6% occupancy. That's it. Our receivables went up. We track real closely our receivables. So in other words, if I'm, let's say 90% occupied, my economic occupancy, in other words, the people who are paying, we try to keep that around 3% to no more than 5%. Once it starts pushing on 5%, that's when we start auctioning. And what we do is we measure what is the gross potential income. I mean, the receivables divided by the gross potential income. So if I'm 80%, I mean, 90% occupied and I'm 85% economic occupancy, that's when we start putting our units in auction to get it closer to the 90%. Now, in the recession, we would go, instead of 3 to 5, we were more like 4 to 6, 4 to 8 maybe, but that was really it. I was in the real estate business. I went 18 months without getting a commission between 2008 and end of 2007 to almost the end of 2009. And thank goodness I was in the storage business, because that's what we lived on. That and refinancing. So typically storage tends to be recession, not proof, but resistant. And here's the reason why. Storage is something that the demand for storage is often created by transitions in people's lives. So in boom times, good economic times, people will go from one house to another, from one job to another. That creates demand for storage. In bad economic times, people lose their jobs, lose their houses, go from larger homes to apartments. That creates demand for storage. Transitions in people's lives create demand for storage. The other thing that's interesting about the storage industry, if you just want me to keep on talking for a minute, is that unlike other sectors of the commercial real estate market, the institutional players, the REITs, only control 20% of the market. So that the vast majority of storage facilities in the US are still a mom and pop industry. 62% of all self-storage facilities are owned by someone who just owns one. So there is a boatload of opportunity in the next decade as this industry follows all the other industries like the apartment business and the retail business and becomes more institutionalized. Our business model is we look for opportunities that we can buy these mom and pops and then bring them up to institutional grade standards. And then our exit strategy will be to sell to the REITs. Why? Because they pay the most. So there's a ton of opportunity, in my humble opinion, over the next decade. What drives these mom and pops very often to the market has nothing to do with cap rates or anything going on with the economy. It has to do with what's a life change they've had, a retirement, a death, a divorce. Then the properties hit the market. Then people like us, investors, can come in, take them, and then reposition them and bring them up to today's standards. So if you look at an industry like in a life cycle like a human being, we're not in the infancy stage, but we're definitely adolescent, maybe teenager, older teenager stage of development as an industry. So there is a lot of opportunity left in this industry. It's probably where the multifamily was maybe back in the late 60s, early 70s, in my opinion. Financing now is a lot easier than it used to be. If there's a negative to it, it's that during the recession, the word got out on how good storage was, and a lot of Wall Street money hit the street looking for self-storage as a place to invest in, and that drove prices up. So for most small investors like us, what we have to do is look for value add plays. It's been a long time since I've been able to buy a storage facility and that's stabilized and then buy it at a price where I could get a return that I need. So we're always having to look for opportunities where we do a value add play. And in some submarkets, they have gotten overbuilt. So you got to be real careful today about checking out the health of that submarket. But the good news is it's very quantifiable. People don't drive across Louisville to rent a storage facility. You're going to rent a storage facility where you live or work. So it's easy to determine how big your market is. And it's also easy to determine what the existing supply in that market is. So we're rarely guessing if we're doing a deal that's going to work. You pretty well know by the time you get into it. So I'll stop there and then open up for any questions and that might take it in a different direction, and I can talk about a number of different aspects of it, but I want to make sure that I'm saying stuff that's relevant to this group.
So as far as questions go, what we're going to try to do is if you can, just type it into or type in the comment, and then we'll individually call on you, just so it's not one group of people trying to all ask questions at the same time. So who would like to
question? Here's one. And this question we hear a lot. Question for the speaker. In your opinion, there appears to be a storage boom here in the Louisville area. Do you think getting started, is it already too saturated? Well, let's say. So first of all, yes, if you look at statistically, Louisville as a market, we're overbuilt. In other words, we brought on probably 20% additional square footage of self-storage in the Louisville market over the past 4 years. However, that is somewhat irrelevant. It plays a factor. It creates some pressure one direction or another, but the statistics of whether Louisville as a market is overbuilt is pretty much irrelevant when you're looking at a deal. And here's why: because I'm not looking at the Louisville market. My customers are not in my customers. 86% of our customers live within 3.2 miles of our facility. So I'm very interested in what's going on in a 5-mile radius of a project I'm looking at. What's going on in Louisville may be putting upward or downward pressure on the rental rates, but it's somewhat irrelevant. I could be in the poster child for an overbuilt market is Dallas, Texas, where they brought in, I think at one point there was 32% more, new product hitting the market, square footage hitting the market at once. But there were sub-markets in there where the way you measure it in our industry is today really the only real metric anyone uses is square feet of storage per capita. Nationally, the average is around 7.5 square feet of self-storage per person in a market area is equilibrium. So if you're over that, theoretically, you're overbuilt. If you're under that, there's still demand. That's adjust somewhat depending on what part of the country you're in. But I've been in, if you looked at Dallas, Texas, and just did Dallas or Dallas Fort Worth, you would be at about 17 square feet per capita. But I've seen submarkets in Dallas Fort Worth where it was 2.3. So there were some real pockets in those overbuilt markets that had a ton of demand. Now, what would happen is getting the ultimate, the highest possible rental rate may have been a little difficult at that time, but that's what's relevant. So it's a little misleading just to think, because you're seeing a lot of self-storage, which you are, that it's overbuilt. And very often I just let people think that because that's good for me, a little less competition. But you really want to look sub-market by sub-market. And even in an overbuilt market, there are places where there's great opportunity, but you got to be very careful. If anything's going on is this industry is becoming more sophisticated. When I met with that acquisition director in the mid-90s, he told me it was a very boring industry and that probably the biggest innovation we've had as an industry over the past 20, 30 years has been climate control. Well, that's not the case nowadays. It's really changing fast. We can go to virtual. I mean, we have touchless move-in today, and it wasn't a big jump for us to start advertising. All we did was lock the office doors. We still have a manager there, but everything can be done through kiosks and online and with your phone. In most of our facilities, you don't even have to punch your code into the key code to open the gate. You just hold your phone up, and if your bill is current, the Bluetooth will read your phone and open the gate. So I mean, it's amazing how fast this industry's maturing and evolving. And probably the biggest challenge for the small investor today is to keep up with that and be relevant in today's market. But you got to be very careful. I've had to walk away from a lot more deals simply because there are more overcrowded submarkets. But take it submarket by submarket, not looking at a market as a whole. Next question. What is your criteria for buying a self-storage facility? Gross margin, NOI, great. I was trained as a CCIM to mostly what the investors I work with would look at cap rates. I got to get it at a 6 cap or a 10 cap or whatever. And that's a valid way of doing it. But when I teach people to get about investing in storage, I ask them, it depends on what your goals are. I help people create their business strategy, why they want to be in, what their short-term, long-term goals are, and design a criteria. And then as you analyze those deals, they either hit your criteria or they don't. So for example, I'm using investor money. So my goal was to pay investors an above market return on their money while I'm using it. And I want to give them their money back within 5 years or so that then at that point, I start getting the majority of the cash flow. They've made an above market return on their money while their money's in our deal. Then I give them their money back plus any unpaid preferred return, and they're still in the deal. They're just in it now at a smaller level because they've got all their money back and they can put it in another deal. So in my case, we needed to average, at one point it was 12% cash on cash return years 1 through 5. as the market got more expensive and more crowded, we got a better track record. I'm now down to 8 to 10% cash on cash for the first 5 years. And I need to be able to create enough value in the deal that I can refinance it in year 5, give my investors their money back. And then at that point, we start getting 70% of the ongoing cash flow. The investors still get 30%, but we get 75% of the ongoing cash flow and 70% of the sales proceeds when we sell it. Investors will get 30 and 30 when we sell it, but they made an above market return on their money while their money was in our deal. And then they can put their money in the next deal we have if they want to. So for us, that was our criteria. For someone else, it might be different. I've worked with people, for example, who want to retire in 5 years or 10 years. So what their criteria is, they look for deals where they can accelerate the loan pay down. So at the time they retire, their loan is paid off, or they have created enough upside that they can refinance the deal and replace their income they're earning from their job. So there's a lot of different criteria. One's not necessarily better than the other. It just depends on what your goals are and why you want to invest. Unlike houses, a lot of like house flipping and other stuff with real estate, other real estate types, with storage, you don't usually buy distressed situations. In fact, if a storage facility is distressed, odds are I don't even want it, because it's something fundamental that I can't fix, like an overbuilt market. Self-storage is the lowest foreclosed on asset class there is, 3.2%. And out of that 3.2%, probably half of them I've seen that are going to auction through a bank foreclosure. It's really nothing to do with the self-storage facility. If you think about out in Prospect, that storage facility out in Prospect that I forget what bank it was, a bank out of E-Town auctioned it a few years ago. It wasn't the storage facility. It was a retail building in the front that never leased up. They couldn't make their mortgage payments, and the storage facility was doing great, but it was additional collateral for the bank. So you typically don't look for, there's not many distressed storage situations out there. So if you're looking for we have to create the value add play through adding more space or through solving a management problem or something like that.
Hey, Mark. So one of the other questions that was before the one you just answered, but it was related to developing new units.
Mm-hmm.
I don't know if you've had experience with that. I'll just read it out to you. Have you ever built before? What do you think about building instead of buying during this downturn with the cheaper labor coming?
Very good. Yes, we've done ground up opportunities. Again, you've got to be a little careful, and it depends on what your goals are. Especially if you can phase in, it's great. So you're never that far ahead of the market. The main thing is you just want to be in a sub-market where there's unmet demand, and whether you buy or whether you build, both are valid options. The thing about building is I don't usually recommend it as a first step getting in, unless somebody's fairly sophisticated or unless they have a construction background. Because when we build from ground up, it's usually about 60% is when we start cash flowing, 55, 62%, somewhere in there. If we've had normal lease up, we'll start cash flowing. And in the storage business today, you might be renting 1,000 to 1,500 square feet a month, or 2.5% to 3% of your square footage absorbed a month. So but most of the time, it's 3 or 4 years before, if you're doing 50,000 and up sizes, it's 3 to 4 years before you're breaking even. So if you can wait that long, it's hard for us using investor money. We've done it, but it's much easier for us to buy a 25,000 square foot facility and add another 25,000 square feet. I may not be generating my 10% year one, but I'm cash flowing year one, and I never get that far behind on the preferred return. So we don't do a whole lot of building. We've done it. I don't like it as much as doing expansions or conversions. But for somebody getting in that's doing it by themselves, it's a real good way. And if you don't run into any problems, you're going to get a higher return on that in the long run than anything else you do. But you've got to be able to fund it for 2 to 3 years in most cases. Good question. Right now, even though we're in quote challenging times, labor costs will be down. We still have a steel tariff in place. Our construction costs our costs for the product have gone up considerably, probably 20% since we've had this current administration. So whether you're doing expansions, conversions, or new construction, you got to kind of take that into mind. But let's talk some numbers for a minute. What you're doing a build out in that retail unit? What's kind of the cost, the per square foot cost for the construction on that retail build out? You don't have to get exact, but
yeah, it's tough to say. The thing with the build out we're doing on the retail space is that it used to be a auto shop. So it's probably going to cost a little bit more than what it usually would. So we have to replace the HVAC system. We have to do a lot of this and stuff. So it's probably between 15 to 20 a square foot, probably to get it.
Well, that's good. That's good. Typically, when you're building a retail center, you're looking what, 55, 60, 50 for the shell plus the build out inside. You do something like a Starbucks. I mean, that's $200 a foot. You build a hotel building, institutional grade hotel. It's very easily 150 to $200 a foot. Office buildings, very high. Institutional grade self-storage, I can build for about 50 to 55 a foot. If I'm going vertical, I might be at 65 to 70 a square foot. So the cost of building storage is probably less than anything you'll build. We use storage fabricators to design our facilities. Institutional grade self-storage facility cost about, in today's world with the tariff, $13 to $15 a square foot to have them fabricate the storage system and deliver it. Cost me perhaps $4.50 a square foot to have it erected. I probably spend $5.50 a square foot on the concrete pad. So the cost of building storage is less than anything you'll ever build for even, institutional grade product. And because that carries its own set of challenges, the fact that it's so inexpensive. Very often our subcontractors would rather be off building a hotel because they can make more money. But I love this business. You can predict your cash flows very accurately. The cost of getting in is a lot less expensive. And other than debt service and a slight reserve fund, there's very little pressure on your net operating income line like there is in anything else. Like I don't fix toilets. I don't replace stoves. I don't paint walls. It's amazing. It's a beautiful investment vehicle, I think.
So another question was, how do you source investors? How do you get out there? If you have a deal, you think it's a good deal, what do you usually do, especially when you first start out, to kind of generate interest in your investment?
Well, when I first started out, I'd talk to anybody who would sit down and listen to me. What we look for, and mostly so far, we've just kind of done Louisville local kind of country club money. And it's good to have, I've got partners who know a lot of quote high net worth people. But what I look for is somebody who's made their money and wants to protect it. So I'm not looking for somebody who's trying to create wealth like us in this meeting. We would be partners and we would be the ones doing the deal and getting the loan and you know, it's not because don't have my money in it doesn't mean I don't have any risk in it. I'm the one on the loan till we refinance it. Then we usually put a non-recourse loan on it. But so we've still got a lot of risk on it. But what we do is look for people who've already made their money and are looking for places to put their money that are safe and get an above market return. So that's how we do it. And that's storage. So when I'm raising money and I'm presenting the deal, of all the things I do, I think I like that the most because that's really the only time I'm ever really selling, and I like selling. I get energy from it. But what I do is first thing I do is I talk about self-storage. And then once I see that they get what self-storage really is, then the next thing I do is I talk about my story inside the self-storage story. And that builds credibility and trust. And then once they get that, then I start talking about the deal. And when I'm done, not everyone invests with us, but I'll promise you they wish they could, because they'll get what storage really is when we're done with it. So that's what we're looking for. Now, how do you get in front of them? Well, it's just networking. You can I would go to, first of all, I would tell my accountant, here's my deal. I'm sure you're working with high net worth people that are looking for places to put their money. My attorney would tell my attorney. We would join in Louisville, there's, I forget what it's called, the Capital Venture Club. These are high net worth people looking for places to put their money. The thing about self-storage is it's fairly boring, and I talk about it like that's a negative, but I know that investors love boring. They love just putting their money in and knowing what their return's going to be. And I talk about it like it's a downside, but I know it's an upside that they like. So I present it as a way to balance a portfolio. What I don't want to do is take somebody's only savings and put it in one deal. So that's where we find our investors.
Awesome. And then I think we had another question. Let me just pull it up real quick. Oh, how do you go about researching a submarket?
Awesome.
Awesome
question. Awesome question. So in the old days, what I would do is I would just Google. I'd pull up Google and lay them out on a map, figure out where the facilities were, then look at them on Google Earth, try to guess how big they were, how many square feet, and then I'd go to the site to do business through the CCIM network and pull up the demographics. Then I would call each of the competition to get a feel for how full they were. And very often I still do this. I'll go rent units at my competition. So I have a code now, and I can go in and walk around and count locks on doors. And but ultimately you get a feasibility report. So all this stuff is preliminary to a feasibility report. The feasibility reports for self-storage tend to be extremely accurate. Why? Well, unlike office or retail or apartments, people will drive across a city to work or to live or to shop. Nobody's going to do that for storage. You're not going to go from the east end of Louisville down to Pleasure Ridge because the doors look cool. You're going to rent units where you live or where you work. And you can quantify so easily what the market is and quantify what the supply is. Now, we're looking all over the country. So there's also some subscription services that you can get nowadays, and they're not 100% accurate, but they don't need to be. And I can look in any address almost in the United States and pull a report up now that will tell me what is the per square foot of storage per capita. Now, is it exact? Not 100%, but it's usually relatively close. Then that will inform me whether I'm wasting my time looking at a deal. Then if I'm not, I'll run my preliminary numbers. And if everything looks good and I can get control of the property or get control of the land, then I order a feasibility report. And that will ultimately inform me how healthy that submarket is, how quick I will probably absorb my any expansion that I do. They'll run their own pro forma that I can compare against mine. They'll give me, they'll even give me optimal unit mixes based on the information that they found. These things are, we live and die by those feasibility reports.
So another question we had was finding deals. How do you go about looking for deals? Do you generally use the basic mediums of CoStar, LoopNet, that sort of stuff, or have you kind of established relationships with people in the market to kind of feed you opportunities?
Great question. Well, my relationship to it, and I'm probably old school, but my relationship to it is the internet is a great device for establishing relationships. So in the storage world, there's, for example, our market is primarily the Southeast and the Southwest, from Kentucky down. Just because that's our business strategy. We just made that up. But there are probably 20 brokers that handle 90% of all the self-storage transactions in that part of the country. So I connected through them initially through LoopNet and Listed, and there's a few places that storage brokers use to market. The Argus Storage Network with those brokers. And but you establish those relationships. And then once you're a buyer, once you buy, it's a small world. And everybody now relates to us as a buyer, not someone looking, but a buyer. So at some point they start reaching out to us. I'm listing a property and, we bought one in Pensacola, Florida. So I would have brokers reach out to me and say, we're buying one and I'm going to be listing one in Pensacola and here it is. And this sounds like this is just what you're looking for. And we use the internet to establish relationships in the brokerage world. And we live and die again by those relationships. And so I highly value those. So I treat those brokers with a lot of respect. If I don't want a product, I'll let them know why I don't want it. And I thank them for giving it to me. I always look for a way to make them look good in front of their clients. I want to be recognized as someone who's easy to work with if you're a broker. So over the years, I've established those relationships, and it's not hard. Anyone can do it. And then the other thing you do is you pick, it's almost like, we have any residential just brokers on here that sell real estate? Remember farming neighborhoods? Well, we don't farm neighborhoods in storage, but you'll pick out a part of the country. It'll be the Southeast or the state of Kentucky or state of North Carolina. And I buy the list of all the storage owners in the area that you want to be known in. And we take the REITs out. And then I stay in touch with those people maybe once a quarter, giving a little bit of valuable information. Here's how many sales happened in your state. Here's the average sale price. Here's what cap rates are, and give them information that they would find interesting. And then just remind them that when they're ready to sell, to call me before you list it. So between those two, I probably have 30 deals in my inbox to look at. I've got more deals to look at than I can look at.
So I think we had two questions kind of similar as far as where can you find the subscriptions you mentioned? I know you mentioned Argus and other.
Now, Reese, they're expensive. Yardi has a Yardi Matrix is one. Now you can get just as, when I did Yardia, it was expensive. It was like 20,000 a year, but it covered the whole country. I could have gotten just the state of Kentucky or just our market area. And now I use Radius is another good one. I can buy those reports, a few $100s per location now. So
was that the feasibility report you're mentioning?
No, that's just the preliminary.
Okay.
Now the feasibility report, I have a website called creatingwealththroughselfstorage.com. And on that website is a resource page, and all the vendors that I've ever used for anything from building to our operating system, to our gates, to our feasibility reports are all on the resource page. So who we have used is on that page right there. But there are people who specialize in self-storage feasibility reports. And you want those because it helps getting the financing, especially if you're doing SBA financing, which for someone getting their first facility, it's a great deal, I think. SBA lendings has a lot of advantages. It's some disadvantages, but a lot of advantages. But you need to have somebody doing a feasibility report that especially if you're using SBA, they have to be approved by that lender. So that's why I have that resource page.
And by the way, I mean, I've read this book. It has all that information in here as well. So if you haven't gotten this book, I really do recommend it. He does lay out everything. And you also have a tool that you created to analyze deals as well.
Because Storage World Analyzer, financial analysis tool. What was interesting is in '95 when I met that REIT acquisition director, I was brokering and managing. We used Yardi for our property management. We used Argus. There's a financial analysis tool called Argus, which is, REITs use it, office REITs, retail REITs. And, I thought I was pretty big deal being able to use all those tools. And I met this REIT director, acquisition, and he's running around with a simple little Excel spreadsheet that he used for his analysis. And so he gave it to me to use because I had to use his formats. And I ended up over the years kind of argusing them up a little bit, adding 10-year cash flows. And over the years that analysis began to evolve, but how do I put it? I'm not the most detailed guy. So very often I would find mistakes because you use the same template over and over again. You've got to check every single formula because you got 10 pages connecting with each other. So I ended up giving that to someone to design a cloud-based software system so I would quit making mistakes with it. Now, the only reason I had to do that is because every other type of commercial real estate, if you're analyzing it, you start with a rent roll, don't you? You enter the rent roll and that gives you your income. Well, that's a terrible way to do it with storage. I've got one facility, we have 1,000 tenants in it. If I had to enter that rent roll, by the time I finished, it would be different. So with storage, you basically have a unit mix, and then you apply a stabilized occupancy to that unit mix. So I had to design a financial analysis tool that was really geared towards storage. So I created that and sell it to people who want it. That's what that is.
So then we'll ask this question, then we'll have probably time for one more. But do you put any money down on deals, or investors put everything down?
Me personally, no, yeah. I don't put. If I put money in a deal, I put it in as an investor. Now I have money in the deal. Very often I'll have some of the initial, costs to go look at the deal. Sometimes the feasibility report. We don't always, close on every deal that we put under contract. But any equity, if I put equity in the deal, and just how we're organized, I put it in as an investor and I get a preferred return on it. No, we don't. So we have investors, and they have a certain level of protection while their money's in the deal. And then when we refinance it and give them their money back in our deals, that's called a conversion. Once the conversion has happened and they get their money back plus all the preferred return due them while their money was in the deal, at that point, certain rights go away. They're still members of the LLC, but they no longer have preferred status. And now we own 70% of the deal. So when we have a vote, whatever we decide is what's going to happen. Prior to the conversion, if we wanted to sell it, it takes unanimous consent. Prior to the conversion, I can't put any more debt on the property without their permission. Prior to the conversion, I cannot bring any more partners in without their approval. Afterwards, we run it. So that's just how we're organized. I don't know that it's the best way, but it works for what we're doing in our strategy.
Awesome. All right. We have time for, I think, one more question if anyone has one.
Now, you've had some great questions. If I was, let me see, do you put any money down?
Yeah,
if I had a few $100,000 and wanted to get in the storage business, I would look for markets around, and to get my feet wet, I might look for a small mom and pop opportunity within a 3 to 4 hour drive, or a place where I could build one. And I would start small, and I would not have a manager on site. I would have a kiosk there, websites where people can rent. And I would get in the business in a small way where I could manage it myself, learn a little bit of it, and then decide if I wanted to get bigger or not. But once you hit stabilized occupancy, I have never, ever once seen a deal go from, let's say, 90%, 85% down to 50 or 60. And I've been looking. I've never seen a stabilized property go from profitable to unprofitable. Even in the recession, I didn't see that. So once you hit stabilized, you may lose some occupancy. You may have to lower your rental rates to compete, but I've never seen a storage facility yet anywhere go from profitable to unprofitable once they're stabilized.
Well, we're running up on 1 p.m. So what we'll go ahead and do is we'll kind of wrap it up. First off, I just want to thank you, Mark, for sharing all this information. We thank everyone on Facebook Live as well. We're live on Facebook. And after this presentation, this is recorded. So we will be sharing the information that you've shared and post any links that you have as well. And if you want, if someone had any additional questions, do you have a contact?
Mark@helmproperties.com is my email. And you can also go to Creating Wealth Through Self-Storage. There's a lot of training and information there. And I do have a YouTube channel, Creating Wealth Through Self-Storage YouTube channel. I probably have 250 training episodes on there at the moment. So if nothing else, get that I think it's a fantastic business. I love every part of it. For small investors, there's nothing better. I mean, I promise. And there's nothing better. You got to design a way to get in it intelligently, but nothing beats it.
Awesome. Thank you so much, Mark, for coming on. We really appreciate it. Great information.
You got it. Okay, guys. Thanks a lot for having me. I hope this is what you wanted in the meeting.
More so.
Absolutely.
Yeah.
Absolutely. Thank you.
Okay. Thanks a lot, guys.
See you, Mark. See you guys. Good seeing you.
Yeah.
Bye.